Today, we are going to look at probably one of the most common topics that gives all the stuff, all the theory that we've been doing, some practical application. Okay, so if you're, and what I mean by that is you're doing business, and fundamentally what it comes down to, if you ask what is business, well, business is about making decisions. It's about being able to make business decisions so that you will maximize the benefit of the business to the owners and to you. So we have learned all of this concept of present value, future values, annuities, all this sort of stuff, because those are important tools in the decision-making process of any business. And this unit is really about some of the typical decisions that we run across in business, of which we use the tools that we learned in order to help make those decisions. And it is not at all uncommon. As some of you may know, I'm on town council here, and I'm also the chair of finance. It is not uncommon at all that these type of decisions are made in every business, including the town of Clarenville. And essentially, what capital budgeting is long-term planning for spending and revenues. Okay, so expenses and revenues. And what we're trying to do, if we're a business person, is we are trying to, if we're in a for-profit business, for example, a construction company or something like that, what we're trying to do is ask ourselves, if we invest in, let's say, a piece of equipment or a building or something, that piece of equipment or building or something will contribute to our organization. It will bring in revenue based on the fact that it exists, okay? Like Walmart will build a building and it's going to generate revenue. Or a construction company is going to buy a D10 tractor, and that tractor is going to bring in revenues over its lifetime. Ultimately, the question that has to be asked is, will this piece of equipment building generate more money in its lifetime than what we're spending on it now? You know, if we were to buy a tractor, for example, and it cost us $1 million to buy a tractor, and the most we could ever generate with the tractor was $50,000, you'd have to scratch your head and say, well, why are we buying a tractor? You know, it's costing us $1 million. It's only going to bring in $50,000, right? So forgetting the time value of money, just ignore that for a second. Let's just assume that this is a simple, no time value of money thing. Effectively, we're going to make a decision that says, that is based on the fact that the piece of equipment or the building or the other capital asset that we're going to buy is going to bring in more than what it costs to buy it. And the thing is, though, you know, if you buy a building or if you buy a piece of equipment, it doesn't bring in money as quickly as the money goes out to pay for it, because you have to buy the tractor, spend $1 million on it, and then over its useful life, it's going to generate money. Now, if we didn't have to worry about inflation and the time value of money, the decision would be really simple. You can say, okay, well, I bought a tractor, I spent $1 million on it, and each year it's going to bring in $1 million, and it will last for 10 years. Okay? So, wow, okay, I spend $1 million on a tractor now, and I make $1 million a year on it for 10 years. Again, forgetting time value of money. You say, well, I invest $1 million and I get $10 million back. And the simple solution would be buy the darn tractor, right? Okay, it's a very simple decision. All we're doing is weighing out how much did we put into this, how much are we getting out of it. If we're getting more out of it than what we put into it, yes, buy it. If the opposite is true, we got to put more into it than what we ever get out of it, don't buy it. Simple. And that's exactly capital budgeting in a nutshell. That's what it is at its root, is will this generate more money than what it costs to buy it? It's a common decision. And in fact, you know, as I say to you, we're in the budgeting process for the town right now, and we're looking at buying some things. and these things are fairly expensive, and we ask ourselves, is it worth buying? Can it possibly bring in more money than we spend on it? Now, in the case of a town's a little bit different. We're not really in the money-making business, right? So we got to ask ourselves, usually in the town, things lose money. Our taxpayer is willing to pay for the loss. That's ultimately what our question is. You know, a new swimming pool, for example. Here's the case. You know, everybody wants a swimming pool, as you probably well know. Everybody would love a swimming pool, but nobody talks about the cost of it. Okay, my job is to worry about the cost of it. So let's say, for example, we buy a swimming pool and it costs $10 million. And each year it brings in $200,000. Okay, $10 million swimming pool brings in $200,000 a year. Got to ask myself, how long will it take to pay off that swimming pool at $200,000 a year? Forever. And so it's losing money. It's actually not making enough money to pay for itself. So who's going to pay the difference? You got to look to the taxpayer. Is the taxpayer willing to pay that difference? Probably not. So again, these are decisions that are a little more complicated than someone on Facebook saying, I need a pool. You know, we need to be able to look at this from a capital budgeting perspective. And that's the way business operates. And your job as someone who is a business graduate will be to help make those decisions. Okay? So here is one of the very important tools that we use in order to help make business decisions, capital budgeting. Of course, I gave you a simple example then to introduce the topic that had nothing to do with the time value of money. But you know, and I know, that the time value of money is absolutely essential. We need to consider the fact that money changes value over time, and that we need to consider the time value of money whenever we make any decisions. So effectively what we need to be able to do then, we take the same scenario. Let's buy a tractor. It's going to cost us $1 million. And we say to ourselves, well, it can make $10 million. It can make $1 million a year for the next 10 years. But what we need to do is find out, well, let's take the time value of all that 1 million, 1 million, 1 million, 1 million, 1 million for the next 10 years and bring it back to today. And let's compare the sum of the value of the revenue it's going to generate over the next 10 years, bring it back to today, and let's compare how much we got to spend on it today versus the value today of how much it's going to generate in the next 10 years. And that's effectively what we need to do. We need to use our present value tools in order to be able to make that decision. So number 4 in the assignment is exactly that. So let's take a look at some of the verbiage here I have here on this slide. So capital budgeting. Okay, this unit will demonstrate a technique used by managers to make sound financial decisions on what we call capital investments. And the word capital in lingo, that's business lingo for a long-term investment, something that's going to last 1 year plus to go and generate money for us. And usually we think of assets being current assets or long-term assets. This is long-term assets, okay? We're going to buy a long-term asset. That asset is going to generate money. We need to think of that as a capital investment. So capital budgeting or capital evaluation is an in-depth process in which we determine whether relatively long-term projects, such as building a new factory, investing in a long-term partnership, is worth pursuing. So a go, no-go decision. Projects are evaluated and ranked according to principles under capital budgeting. And the funds used for these types of projects are typically referred to as capital expenditures. And in a perfect world, businesses should pursue all projects that produce positive cash flows, meaning that it makes more money than we spend on it. Ultimately, that's going to enhance shareholder value, and that's what you'll be rewarded for as manager. So in this unit, what are we going to do? Well, we're going to calculate the net present value of capital investments using the net present value really to decide whether or not we should invest in the business. We're going to evaluate leasing versus buying. That's a kind of a spin on this capital investment thing. We're going to, under conditions of capital rationing, use the best combination of investments to group capital certain capital investments. All that means is that we have many choices. We can do this project, that project, or another project. Which one should we invest? Considering we only have so much money, we can't do them all. So considering we only have which one are we going to invest in? Select the best investment from two or more mutually exclusive investments. We're going to calculate what's called the internal rate of return, which is a fancy word for like the interest rate or the value in terms of the rate of return on an investment. And use IRR to decide whether the investment should be made. And we're going to calculate the payback period of the capital investment. So these are all very practical applications of all the material we've learned, and absolutely essential in the business world, and absolutely something that will be tested in the final exam. So essentially, when you boil it all down into simple terms, when we think about capital budgeting, we are looking for what's called a positive net present value. In other words, it's worth more to do it than not do it. So we basically ask this simple question: how much do we need to put into a project? How much are we going to get out of it? If we're going to get more out of it than what we put into it, go. If we've got to put more into it than what we're going to get out of it, no go. So effectively, the decision is relatively simple. The application of that is probably not so simple. So we do this from a mechanical point of view by looking at what's called the valuation principle. And we've got to identify, in order to do that, we really need to identify the cash flows that are expected out of a project. Okay, and this is where it gets gray, and this is where some skill that comes involved to say, how much can we reasonably expect in terms of budgeting? How much can we expect this item to generate for us? This new building, new piece of equipment, whatever. How much do we expect it to generate for us? And we need to be able to come up with a way to estimate that. And there's all kinds of ways to do that, and there's lots of standard figures. But generally, we need to be able to think about it in terms of over the next X number of years, how much is this going to bring in a year? And then we're going to have to estimate, too, how much are we going to have to spend up front or along the way in order to make that happen. Okay? So we're really looking at the net cash flow as being cash inflows minus the cash outflows. We got to determine, too, what the rate of return is. And what does that mean? Well, you ask yourself, well, how much did this make if, for example, we buy a tractor for $1 million and it's going to generate us $10 million over the next 10 years, $1 million a year? We might say, okay, that makes sense. Looking at it on the surface, that makes sense. We spend $1 million, we get 10 back. Good. But really what we got to ask ourselves, is that the best choice of the use of our money? Maybe putting the money in the bank or a savings account or some investment will earn a higher rate than buying a tractor and running it for 10 years. Maybe there's a better option out there. And we really need to ask ourselves, well, how much is this in terms of what do we need? What is the kind of I'll call it the hurdle. What is the rate of return? If we can make 10% a year on an investment, well, maybe we could take that $1 million, it'll earn $100,000 a year in the first year, and then compound interest, it'll earn $110,000 and so on. So we ask ourselves, is that really a better option? And if interest rates are high, let's assume that we're in a period of very high interest rates. We have to ask ourselves, are projects as easy to fund in high interest rates? Well, you think, well, interest rates are high, the cost of borrowing is higher. I'm probably not going to be able to do it because the cost is going to be too high because the interest rates are high. We also have to look at it from the point of view, well, if interest rates are high, we can earn a higher return. And it could change the economics of the project. We need to be able to think about all that money that we're going to borrow and we're going to pay interest on it. Is it going to be more expensive to run that project? So effectively, it all comes down to calculating the present value of the stream of payments that we, the basically the flow of money that's going to generate in. We got to think about taking that back to now, comparing now against now, and using that interest rate that is the market interest rate, or what we consider to be the hurdle, what we call the hurdle rate, which is really the rate of interest that we need in order to make this go ahead. And so we need to be able to calculate the sum of the present values in order to do this. So I hope that is clear. The basic concept is clear, that we need to generate more money in than what we put out. First of all, that's the thing. We also need to calculate the present value of the money and compare it to what the present value of what we put out is. And we also need to think about, well, is there a better option out there? Is this the best option? And if it's not the best option, maybe we should just reconsider and do a better option that has some more positive background to it. So let's look at a very simple example right up front. This is one of the first ones you see in your chapter. So a low-risk 4-year investment promises to pay $3,000, $6,000, $5,000 at the end of the first, second, and fourth years, respectively. Again, we got to get into timelines here. And another thing that you're going to find is we have to make an assumption. The assumption is that the money comes in at the end of the year. Now, you're going to say that's probably not realistic. But for the purposes of this analysis, we want to think about we're going to be able to pick a point in time. And in order to determine whether it's an annuity or an annuity due, we really need to think about what side of the year does it come in on. So usually it comes in at the end of the year. We're going to notice that. So a cash injection of $1,000 is required at the end of the third year. The investment may be purchased for $11,000, which would have to be borrowed at an interest rate of 5%. Use the valuation principle to determine whether the investment should be undertaken. So really here, we got to think about drawing a timeline. Now, I don't have a timeline drawn here, and I probably should. I should think about a timeline. So I'm going to do this on the fly now. Let's assume that here's a simple timeline. I'll just draw this timeline here. It's probably not very straight, but here it is. And it basically says a low-risk 4-year investment promises to pay $3,000, $6,000, and $5,000 at the end of the year. So first of all, just okay, so this is now. Okay, let's assume that our timeline starts with now. And year one, I'll call that year one. And year one, we have, let's say, $3,000. Okay. I'm going to put a plus on that because that's money coming into the business. And the end of the second year, we have, what's that, plus $6,000 coming in. Okay, so going to make that the second year. And the fourth year, so we're going to miss 1 year. I'll put the little strokes in after. Fourth year, we have $5,000 coming in. Okay. So effectively, this is where the positives are coming. This is money coming in. Just here, and I'll put that there. Okay. So, and I'm going to put another one here just to indicate that. Sometimes it doesn't work as well as what I'd like. Okay, so there's our flow of money in. The cash injection of $1,000 is required at the end of the third year. So basically, the third year is this year here, and I'm going to put that there as minus 1,000. Okay, so we've got this type of arrangement. This is what you want to do, is to make sure that you have a timeline. The investment may be purchased for $11,000 right now. So I'm just going to put this in here. So effectively, that's what that's saying, is that $11,000 now. And then we're saying, okay, the interest rate is 5%. So effectively, what we're doing is we're discounting all this back. So what we got to do is bring it back to now. Now, fortunately, at $11,000 now, so we really don't need to do anything on that. We're looking at everything as relative to now. So what you need to do is to take this $3,000 and bring it back 1 year. We're going to take this $6,000. We got to bring it back to 2 years. We got to take this $1,000 that we got to spend out. We got to bring it back to 3 years. And we got to take this $5,000 and bring it back 4 years. Keeping in mind that the positive and minus signs, the plus is money coming in, minus is money going out. So here's the mechanics of it. We take the 3,000 and we're just simply doing a simple present value calculation here. So we take 3,000 divided by 1.05, 5% interest rate. And that means that that 3,000 is worth $28.57 now. We take the 6,000, which is in 2 years' time, notice to the power of 2 here. We bring it back, and again, now it's worth $5,442. We take the 1,000 that we're going to have to put into it. Notice it's a minus, money coming out. So it's in 3 years' time. And that's minus $864. So that's a minus $864. That's money going out. Take the 5,000, we're going to bring it back 4 years. 5,000 to the 4, and that's a positive. So really, okay, when we add these up, okay, what they've done here is they've taken just these amounts right here, okay, and they basically added them up for the purposes of the present value. So it comes to $11,549. So this is a positive amount, meaning that there's $11,000 worth of stuff coming in. Okay, so we're asking ourselves a basic question. We spend $11,000 now, and we get the equivalent of $11,549 in now. So the question asked is, what would you do? Well, 11,000 out, 11,549 in. That's a positive amount, 549 to the good by doing the project. So the 11,000 should be accepted. By paying a price that's below the 11,549, the business will realize a rate of return on investment greater than 5% of the capital financing investment. Now, I hope you see that. Okay, so really all we're doing in this is a very simple calculation. What we're doing is saying, okay, considering our pluses and minuses, money going out, minuses money coming in, we're drawing it all back to now, and we're comparing what we're going to get, the flow we're going to get versus what we got to put out now. If the money that we're going to get is higher than the money that we go out with, let's do the project. That's effectively what we're doing here. So that's essentially what capital budgeting does. Now, just this kind of illustrates some of the permutations here. You know, I said, well, you got to consider money that we're putting out. You can put money out at any point in time. You still got to discount it back. So putting the minuses on it for money going out and pluses on it for money coming in makes the equation that much more simple to do. Okay, let's look at another one. Repeat the problem with the change in the interest rate on the loan to finance the investment. So assume that the interest rate is now 8% instead of 5%. We got exactly the same calculation. Again, no different, but it's 8%. Same scenario. And notice if we do it at 8%, if the interest rate is 8%, the sum value of what we got coming in is $10,803. So we got to spend 11, and we're only going to get 10 back, 10,803 back. So this would change the water on the boards very significantly, because we're going to say, we're going to spend more than what we're going to get. We're not going to do the project. The interest rate goes up and make projects less feasible. This is why interest rates are very important to determining whether a project is going to go ahead or not. Okay, so that's effectively how these things work as we compare one with the other. Okay, I believe I have, if I'm not mistaken, I know I'm not mistaken, I watch this to make sure, a little example here that I probably explained.
Hello everyone, welcome back. It's Paul Tilley. In this part of the unit, we're looking at decisions that business people make every day, and we use financial tools in order to help make those decisions. Particularly in this section, we want to look at two basic decisions. First, should we invest? Is this the thing that we need to do? You know, every investment has a certain expense related to buying it, and there are rewards that come of owning it. The question is, will the rewards be greater than the cost of buying it? So the should we invest question really says, can we make money on this? And we'll look at an assessment for that. The second thing we're going to look at is a common business decision these days, and that is, should we lease a piece of equipment or an asset or something, or should we buy it? So, without further ado, let's take a look at that in detail. The first thing we look at is a basic question that is paramount to all business. Should we invest? And when we think about investing, and we've talked within the context of this course, we've talked about the time value of money. The time value of money comes into play here because investments tend to be long-term. This is why we call it capital. Capital, and the term capital budgeting, comes from the idea that this is a long-term decision. It's not something that we're going to buy and use up today or tomorrow or the next day. This is a piece of equipment or some particular asset that's going to last a long time. As a result of that, the decision-making of buying it and the return from it really has to be considered over a period of time. So we really need to think about the time value of money. So essentially, when you boil it down in terms to the basic decision here from a financial point of view, we're comparing two things. We're looking at the cash flow in from a particular product. So let's say, for example, we buy a tractor. I'll draw a tractor. I like drawing tractors. So I'll draw a tractor.
I do. I love drawing tractors.
A little piece of equipment here. Okay, let's assume that we're buying a tractor. And that tractor is going to cost us, I don't know, $100,000. Okay, so we're gonna do that. So that's money that's going out. Okay, that's money that's going out. And the thing is, we're going to use that tractor over its life, and we're going to make money on it. So let's say, for example, we're going to make $40,000 in the first year, and $40,000 in the second year, and $40,000 in the third year, and then we're going to sell it. Okay? So the question is, should we buy it or not? So we got 3 times $40,000 coming in. So I do the math on that, and I said it's $120,000. Now let's just ignore the time value of money for a second, okay? And let's assume that we sell it, I don't know, for $10,000 at the end. Okay, let's look at this from a rational point of view, ignoring the time value of money. We are taking $100,000 out of our bank account now and paying for that tractor. Okay, we're going to get that tractor. Over the course of the next 3 years of its useful life, we are going to make $120,000 in revenue from that piece of equipment. And we're going to sell it for $10,000. So that comes to, again, ignoring the time value of money, $130,000. Now I ask you, should we buy that tractor or should we not? And your answer is probably at this stage, yes, let's buy the tractor. Again, why? If you don't understand why, well, you spent $100,000 and we made, it brought in for us, in other words, the cash flow in from the tractor was $130,000 when you consider the $120,000, $40,000 a year for 3 years, plus the $10,000 when we sold it. So it's $130,000. So $130,000 in is more than $100,000 out. So the business decision should be, yeah, let's buy the tractor. Now it's simplistic. And essentially, that's what it boils down to. That is what we're doing here, is we're making that simplistic decision. However, we're adding the wrinkle of the time value of money. Okay? We have to recognize that $1 today is worth a different amount than $1 at some point in the future. So let's take this exact same example of buying a tractor. I'll draw the little tractor again because I like drawing tractors. Okay, so essentially we are paying $100,000 right now. So in terms of the time value of now, the time value of now is $100,000, and that's out. Okay, there's $100,000 going out if we look at that. Now let's take a look at the future. Let's look in. So in year one, we have a tractor that is going to generate $40,000 for us in that first year. Let's assume that it makes $40,000 in the first year. Now the first year, the thing is with that is we need to look at what the time value of money is. So again, I'm assuming the $40,000, and there are some assumptions I'm making here. $40,000 comes in at the end of the period. Let's assume interest rates at the time. We're going to borrow on that to buy that tractor. Let's assume the interest rate is 20%. Really, really high. It's a really high interest rate. That's what the company can borrow. Okay? So when we go take that $100,000, we're getting a loan on it, we're paying $100,000 on it, that sort of thing. So we got to be able to draw in enough money to cover that. So from the point of view of here, in terms of the cash flows, we have to discount our cash flows to present value at a rate of 20%. So in order to do that, in the first year, we know that present value is the amount, which in this case is the payment, over 1 plus I. And that 1 plus I depends on what year it is, so the N. So we're just simply looking at 3 years. So in the first year, again, I'm assuming very simplistic here that $40,000 always comes in at the end of the year. In the first year, then the payment is $40,000, 1 plus, and we said that the interest is 20%, 0.20 to the 1. So that's what that value will be worth at year 1. So that's 40,000 divided by 1.20. And that comes to 33,333. So essentially, what we're saying is that $40,000 1 year for now is worth that much. 33,333 is worth that much now. Let's take a look at the second year then. And this is all predicated on, again, a 20% rate. The second year, we have $40,000 coming in. We said that every year we're making $40,000 for 3 years. It's 1.20. Now, again, that's I've just taken 1 plus 0.201 to the power of 2. And that is the same as 40,000 divided by 1.44, and that is 27,778. Again, I'm rounding here. But essentially, that $40,000 coming in 2 years' time is worth $27,000 now. Now, in year 3, we're going to do 2 things. First of all, we've got the $40,000 coming in, and from the revenue on the machine, and that's 1.20 is again, considering the interest rate, to the power of 3, because it's 3 years. So that's 40,000 divided by 1.7228. 23,148. Okay, and again, I'm rounding again, but essentially that $40,000 in 3 years' time is worth $23,148 right now. Now, in year 3 as well, as soon as we're done with year 3, let's assume that, so it's still year 3, we're going to sell the machine. I said we'd get $10,000 for it. So we're going to take the $10,000 and we're going to discount that money that we're going to get in our hand in 4 year time. We're going to discount that back to today. So we're going to put 2 to the 3. It's the same year, so we're using this same amount. So that's the same as 10,000 divided by 1.728. And that's 5787. So essentially, and again, I'm rounding, so you got to be careful here to appreciate the fact that I'm not worried about decimals. This is for decision-taking purposes. This is not making payments, so we're just trying to make a decision. We don't have to worry too much about rounding here as long as we can get a reasonable answer. So essentially, what we're saying is that if we took all these amounts of money, we brought them back to now. So essentially what we have to do is add all those up. So we're going to take the 5787 plus the 23,148 plus the 27,778 plus the 3,333.0, and that comes to 90,046. Okay, so here's what we've done. We spent $100,000 on a tractor. We're going to use the tractor for a number of years. It's going to generate revenue for us. We've calculated the revenue. We brought it back to today. What is the value today of these flow of money? The today value of that flow of money is $90,000. So we spent 100, we're getting 90 back. Should we buy the tractor with 20% interest rate? The answer, certainly no, we should not, because we're spending more than we're getting back. So when we make these decisions, this financial tool is a useful tool. Again, considering the time value of money, it's a useful tool in order to help make those decisions.